Something happened in June 2024 that should have dominated headlines for weeks. It didn't. Most Americans never heard about it. There was no dramatic announcement, no press conference, no crisis meeting at the White House, just a quiet expiration of an agreement that had, for 50 years, been one of the fundamental pillars of American global power. The petrodollar agreement between the United States and Saudi Arabia ended. After half a century, the deal that made the dollar indispensable to global energy markets simply lapsed, and Saudi Arabia chose not to renew it. Let me tell you why this matters, and let me tell you what Saudi Arabia is doing now, because it's not just walking away from an old agreement. Riyadh is executing a completely new oil strategy that's reshaping global energy markets and, in the process, undermining American financial dominance in ways that most policymakers are only beginning to understand. The original deal was struck in 1974, and it was brilliant American strategy. In the wake of the oil embargo and the collapse of the Bretton Woods gold standard, Henry Kissinger negotiated an arrangement with Saudi Arabia. The Saudis would price oil exclusively in dollars and recycle their oil revenues into U.S. Treasury bonds. In return, America would provide military protection, weapons, and security guarantees to the Saudi kingdom. Think about what this created. Oil is the most traded commodity on earth. Every country needs it. If oil is priced only in dollars, every country needs dollars to buy oil. Japan needed dollars. Germany needed dollars. China needed dollars. Brazil needed dollars. This created permanent, insatiable structural demand for U.S. currency worldwide. And what did countries do with all those dollars they accumulated? They invested them in U.S. Treasury bonds, the safest dollar-denominated asset. So dollars flowed out of America to buy oil and then flowed right back to finance American government spending. It was a perfect circle. The U.S. could run enormous deficits, print money, maintain the world's largest military, and consume far more than it produced. All because the petrodollar system created guaranteed demand for dollars and treasury bonds. This wasn't just about economics. This was about power. The ability to print money that the world must accept is an extraordinary privilege. It allowed America to sanction countries by cutting them off from dollar markets. It allowed us to borrow cheaply because foreign central banks needed somewhere to park their dollar reserves. It allowed us to run a $1 trillion trade deficit without suffering currency collapse. That system is now unraveling, and Saudi Arabia is leading the unraveling. Here's what's actually happening on the ground. Saudi Arabia now accepts payment for oil in multiple currencies: yuan, euros, yen. This isn't hypothetical or future planning. This is operational policy right now in December 2025. Approximately 25% of Saudi oil exports to China, their largest customer, are being settled in yuan rather than dollars. Let me put that in concrete numbers. China buys roughly 1.8 million barrels of Saudi oil per day. At current prices around $75 per barrel, that's about $135 million daily, or nearly $50 billion annually. A quarter of that, roughly $12 billion per year, is now transacted in yuan instead of dollars. That's $12 billion annual oil trade that has completely exited the dollar system from just one bilateral trade relationship. But it's not just China. Saudi Arabia is exploring or implementing similar arrangements with other major customers. India, the world's third largest oil importer, is discussing rupee-based oil purchases. European buyers are being offered euro pricing. Japan and South Korea are exploring yen and won settlement for portions of their Saudi oil imports. And this is just Saudi Arabia. The UAE has followed suit, establishing yuan clearinghouses and facilitating multi-currency oil transactions through Dubai. Iraq announced it would accept yuan for oil sales to China. Kuwait and Oman are exploring similar options. Even non-OPEC exporters like Russia and Iran, already shut out of dollar markets by sanctions, are pioneering alternative currency oil trade that's becoming normalized. What we're witnessing is the systematic dismantling of the petrodollar as the exclusive mechanism for global oil trade. Oil is still often priced in dollars as a reference point, but actual settlement is increasingly happening in other currencies. The distinction matters. Pricing in dollars but settling in yuan means countries need fewer dollar reserves. They can buy oil with their own currency, or yuan, not dollars. Now you might ask, why is Saudi Arabia doing this? What changed? The answer is complex, but it comes down to several factors. First, the kingdom is looking at where its future markets are. Europe is in slow economic decline, aging, moving toward renewables. The United States is increasingly energy independent thanks to shale oil and fracking, but Asia, China, India, Southeast Asia is where energy demand growth is happening. These are Saudi Arabia's customers for the next 30 years. And those customers, particularly China, are pushing for yuan settlement. China doesn't want to hold massive dollar reserves that Washington can freeze at any moment. They've watched Russia's $300 billion in reserves get frozen. They've watched Venezuela, Iran, and Afghanistan face similar asset seizures. Beijing has concluded that dollar reserves are a vulnerability, not an asset. So they're offering Saudi Arabia a deal. We'll buy your oil in yuan, and you can use those yuan to buy Chinese goods, invest in Chinese markets, or convert them to gold on the Shanghai Gold Exchange. For Saudi Arabia, this is attractive. It diversifies their currency exposure. It gives them leverage with Washington. If the U.S. knows Saudi Arabia has alternatives, American demands carry less weight, and it aligns them with the world's largest oil importer and second largest economy at a time when China's influence is growing. Second, Saudi Arabia is deeply committed to Vision 2030, Crown Prince Mohammed bin Salman's plan to diversify the economy away from oil dependence. This requires massive infrastructure investment, new cities, tourism development, technology sectors, entertainment industries. China can build all of it. Chinese construction companies, technology firms, and manufacturers can deliver what Saudi Arabia needs, and they'll accept yuan as payment. So a pattern emerges. Saudi Arabia sells oil to China for yuan. They use those yuan to pay Chinese companies to build Vision 2030 projects. The money circulates in a closed loop that doesn't involve dollars at all. It's similar to how the petrodollar worked. Dollars for oil, oil revenues recycled into U.S. Treasury bonds, except now it's yuan for oil, yuan recycled into Chinese goods and investments. Third, and this is crucial, Saudi Arabia is hedging. The kingdom has watched American foreign policy become increasingly unpredictable. We abandoned allies in Afghanistan. We've been inconsistent on Middle East policy. Different administrations have vastly different priorities. The U.S. threatens Saudi Arabia over human rights, over oil production levels, over Yemen. Meanwhile, China offers partnership with no political conditions, no lectures about democracy or women's rights, just straightforward commercial relationships. If you're Saudi Arabia's leadership, you're asking yourself, is exclusive alignment with an unpredictable partner wise? Or should we diversify our partnerships, maintain good relations with Washington, but also build deep ties with Beijing? The answer is increasingly the latter. Fourth, the energy transition is coming, slower than some hope, but faster than others fear. Saudi Arabia knows that in 20 or 30 years, oil demand may peak and decline. They need to maximize oil revenues now while they can, and that means selling to whoever will buy in whatever currency they prefer. Insisting on dollar-only sales might cost them market share to competitors willing to accept yuan or euros. Now let's talk about what this means for the United States, because the implications are profound and alarming. The petrodollar created automatic permanent demand for U.S. currency. Every barrel of oil sold worldwide generated demand for dollars. That's roughly 100 million barrels per day globally, about $7.5 billion in daily transactions at current prices, over $2.7 trillion annually. If even 20% of global oil trade shifts to non-dollar settlement over the next 5 years, and current trends suggest it will, that's over $500 billion in annual transactions exiting the dollar system. That might not sound catastrophic, but think about the second-order effects. Countries need to hold fewer dollar reserves if they're buying oil in yuan or euros. Central banks have been the largest holders of U.S. Treasury bonds, parking their dollar reserves in the safest dollar assets. If they need fewer dollar reserves, they buy fewer Treasury bonds. The U.S. government currently borrows about $2 trillion annually to cover deficits. We depend on foreign buyers to absorb a significant portion of that debt. If foreign demand for treasuries falls because central banks need fewer dollar reserves, who buys the debt? Either domestic buyers, meaning higher interest rates to attract them, or the Federal Reserve prints money to buy bonds directly, which risks inflation. Higher interest rates mean higher debt service costs. The U.S. already pays over $1 trillion annually in interest on $36 trillion in debt. If rates rise even 1 percentage point because foreign buyers are absent, that adds another $360 billion in annual interest costs. That's money that can't be spent on infrastructure, education, defense, healthcare. It's just interest payments. The trade deficit becomes harder to sustain. America imports about $1 trillion more in goods than we export annually. This is only manageable because the world needs dollars and will accept them as payment. But if dollar demand falls, the trade deficit puts downward pressure on the currency. The dollar depreciates, imports become expensive, inflation rises, living standards decline, American sanctions lose effectiveness. Much of U.S. sanctions power comes from control over dollar clearing and access to dollar markets. If countries can conduct major transactions in yuan or euros, getting cut off from dollar markets becomes less catastrophic. Iran already trades with China in yuan. Russia does the same. As more countries develop non-dollar trade relationships, the threat of sanctions carries less weight. This is already happening. When the U.S. threatened secondary sanctions on countries buying Russian oil, India and China largely ignored the threat. They developed rupee ruble and yuan ruble payment mechanisms and kept buying. The sanctions didn't fail completely, but they were far less effective than Washington expected. Part of that is because alternative payment systems exist and function. The geopolitical implications extend beyond economics. American influence in the Middle East has always rested on two foundations: military power and economic interdependence. We provide security, and they price oil in dollars and invest revenues in America. That created alignment of interests. Saudi Arabia's wealth was tied up in dollars and treasury bonds, so they had a vested interest in American economic stability and dollar strength. But if Saudi wealth is increasingly in yuan, in euros, in diversified assets outside dollar markets, that alignment weakens. Their interests become less tied to ours. They become more willing to pursue independent foreign policies that might conflict with American preferences. We're already seeing this. Saudi Arabia normalized relations with Iran in 2023, brokered by China, without consulting or even informing the United States in advance. That would have been unthinkable 10 years ago. Saudi Arabia joined BRICS, again without seeking American approval. The kingdom is pursuing independent relationships with Russia, with China, with regional players, based on Saudi interests rather than American preferences. This is what happens when economic interdependence weakens. The leverage that comes from it disappears, and leverage is power. Now, let me tell you what makes this particularly difficult for American policymakers. We have very limited ability to stop Saudi Arabia's new oil strategy through conventional means. We can't force Saudi Arabia to price oil only in dollars. They're a sovereign nation making sovereign economic decisions. We can't sanction Saudi Arabia without devastating consequences for global oil markets and our own economy. Saudi Arabia supplies about 10% of global oil. Sanctioning them would send oil prices to $150, $200 per barrel, causing global recession. That's not a viable option. We can't offer Saudi Arabia something more attractive than what China offers, because what China offers is a massive market with no political conditions. We come with demands about human rights, democracy, Yemen, women's rights. China comes with construction contracts and technology transfers. For an authoritarian monarchy worried about regime survival, China's offer is often more attractive. We can't prevent other countries from accepting non-dollar oil payments without basically trying to control sovereign decisions of nations around the world. That's not feasible and would accelerate the very trend we're trying to stop by confirming that the dollar is a tool of coercion rather than a neutral medium of exchange. The policy options being discussed in Washington are all variations of damage control. maintain close security relationships with Saudi Arabia and other Gulf states to preserve some leverage, develop American alternatives like a digital dollar, though we're years behind China's digital yuan, keep the dollar attractive through responsible fiscal policy, though $36 trillion in debt and deep partisan gridlock make that difficult, negotiate agreements to maintain some dollar pricing, even if settlement happens in other currencies, though that's a weak compromise. There's also discussion of more confrontational approaches. Threaten to withdraw security guarantees if Saudi Arabia continues multi-currency oil sales, restrict arms sales or technology transfers, use intelligence sharing and military cooperation as leverage. But these are desperate measures that could backfire, pushing Saudi Arabia further toward China and Russia rather than pulling them back toward the United States. Here's what keeps me up at night about all this. The petrodollar wasn't just an economic arrangement. It was the foundation of a global order where American financial power was unmatched. That order is ending, and we don't have a clear strategy for what comes next. Do we accept a multipolar currency world where the dollar is important but not dominant? Do we try to maintain primacy through other means, technological leadership, military power, alliance networks? Do we compete with China's economic statecraft by offering our own infrastructure, investments, and development financing, but without the political conditions that make our offers less attractive? These are strategic questions that require serious debate and difficult choices. Instead, we're getting denial and reaction. Denial that the petrodollar era is ending. Reaction to individual Saudi decisions without understanding the larger pattern. Saudi Arabia's new oil strategy isn't an isolated policy. It's part of a fundamental shift in global energy markets and, by extension, global financial architecture. The kingdom is positioning itself for a world where China is as important an economic partner as the United States, where Asia drives energy demand growth, where currency diversification is prudent risk management, where exclusive alignment with any single power is strategically unwise. And they're not alone. The UAE is pursuing similar strategies. Iraq is following. Even smaller Gulf states are exploring options. This is becoming the new normal in energy markets: multi-currency settlement, diversified partnerships, strategic hedging. The global energy order is changing fast, faster than most people realize. The petrodollar system that gave America extraordinary financial power for 50 years is being systematically dismantled, transaction by transaction, barrel by barrel, currency by currency. This doesn't mean American power collapses overnight. We remain the world's largest economy, most powerful military, most innovative technology sector. But it does mean we're losing a unique advantage that no other country in history has possessed: the ability to print money that the world must accept. And we need to reckon with that reality. We need to have honest conversations about what American power looks like in a post-petrodollar world. We need to develop strategies that don't assume permanent financial dominance. We need to compete effectively with China's economic statecraft without resorting to coercion that drives countries away. Most importantly, we need to recognize that Saudi Arabia's new oil strategy isn't a betrayal or a temporary aberration. It's a rational response to a changing world where American power is no longer uncontested, where alternatives exist, where diversification is prudent. The question isn't whether this shift will continue. The infrastructure is being built: yuan clearinghouses, multi-currency settlement systems, alternative reserve assets. The incentives are aligned. China wants to reduce dollar dependence. Saudi Arabia wants to diversify partnerships. Other countries want options. The question is whether we'll adapt intelligently to this new reality, or whether we'll cling to outdated assumptions about petrodollar permanence until crisis forces painful adjustment. Saudi Arabia is making its choice. The global energy order is changing, and America's financial dominance is eroding. We're living through a historic transition. The only question is whether we'll recognize it in time to shape the outcome, or whether we'll be shaped by forces we failed to understand until it was too late. The petrodollar era is over. What comes next will define American power for the next half century. And right now, we're not writing that future. Saudi Arabia, China, and others are writing it for us.